Two more limits to fiscal policy are what is known as a drop in the bucket and timing issues. First, let's consider a drop in the bucket. Normally, the changes in fiscal policy as a percentage of GDP are small. Consider the stimulus plan passed under President Obama in 2009. It was the largest economic stimulus plan since World War II. The plan was set such that the stimulus would be spread over 3 to 4 years. At its peak, however, the spending was only about 2% of annual GDP. Therefore, it had relatively little impact on the economy. In September 2010, in fact, the unemployment rate was still hovering around 10%. So a lot of times when we impose fiscal policy, the policy itself is not large enough to make any kind of difference. Then there's the issue of timing the policy. Fiscal policy is intended to correct short-term problems. Often, by the time fiscal policy is in place, the economic conditions have often changed. So you're trying to put in an expansionary policy, but by the time you get around to implementing it, maybe the country's already out of recession, for example. Some of the relevant timing lags include recognition lags. You first of all have to recognize the problem. And as we mentioned earlier in the course, identifying the beginning of a recession takes months. Sometimes it could be 6-9 months after a recession has started when it's officially announced that the country is in a recession. Then you have legislative lags. Congress must propose and pass a plan. We all know that Congress doesn't work too fast, so that's an example of a timing issue that may make the policy be implemented too late. Then you have implementation issues. Once the plan has been passed and the money has been distributed, then you have to implement the plan, and that can take time. In fact, with Obama's stimulus package, one of his conditions of people receiving money was that the projects were shovel ready. They were ready to go. They were not going to do it such that they would distribute the funds to the different states, and then at the state level you'd have to make a decision about where the money would go. Then there's the effectiveness issue. It takes a while for the plan to work. We talked about the multiplier process. So the government can put in that first marginal amount of spending, but then it can take time till the spending goes from one consumer to another to another. So it can take time for the plans to work, and so effectiveness is an issue. And then of course, any kind of plan should be evaluated and adjusted. Is the plan working? Have conditions changed? Should we put in more stimulus? Should we remove some of the existing stimulus? These are all important lags that one has to consider when implementing fiscal policy. Now, monetary policy is also subject to lags, but generally their lags are shorter than the lags we see in fiscal policy. For instance, the Federal Reserve can act very quickly. They don't have that legislative lag like we see with fiscal policy. In fact, the day after 9/11, the Fed stepped in with massive infusions of cash to the banking system to make sure that it didn't collapse. The only real advantage of fiscal policy, however, over monetary policy is that the effectiveness lag is shorter. Once that government spending goes into the economy, someone's income has automatically increased. Monetary spending is not as effective. The Fed can put more money into the economy, but the impact of monetary policy ultimately depends on whether banks are willing to lend that money and businesses are willing to borrow. Due to these long lags, critics of active policy argue that such policies may destabilize the economy rather than help it. In other words, by the time the policies affect aggregate demand, the economy may actually not be in the recession anymore. That is, the economy's conditions may have changed. These critics contend that policymakers should focus on long-run goals like economic growth and low inflation. These critics say, look, we already have what are known as automatic stabilizers built into the system. Automatic stabilizers are changes in fiscal policy that stimulate aggregate demand in a recession without any kind of explicit or discretionary action being taken by the policymakers. So for instance, we have welfare and transfer programs that kick in during a recession. In a recession, more people apply for welfare assistance and unemployment benefits. As a result, this helps to stabilize their income. their consumption and therefore aggregate demand. You also see another automatic stabilizer, which is not a product of the government, this one being more of a private stabilizer. Whenever the economy falls into a recession, if people have savings, they will draw on those savings during the economic downturn. If they don't have savings but they have some decent credit, then they'll use credit cards to help them smooth their consumption. Again, this will mitigate the impact that the recession has on aggregate demand. Our tax system is tied to economic activity. So when the economy goes into a recession, taxes automatically fall. This stimulates aggregate demand and reduces the magnitude of fluctuations in spending. It's worth noting that there are political and economic differences in the fiscal policy tools selected. Regarding the political differences, tax cuts are preferred by Republicans. The tax cuts put more money into the hands of the private sector, lets them spend the money as they wish. As we saw, President Bush, who was a Republican, favored tax cuts or tax rebates. Spending, however, which grows government, tends to be favored by the Democrats. And we saw that the Obama administration's plan of choice was to pass a stimulus package. Although it should be noted as well that the Obama package did include an extension of some tax cuts that were originally implemented by the Bush administration. Now, there are also economic differences between the impact of a tax cut versus government spending. Government spending is a more certain influence on the economy, but it's slower. The government spending means an automatic injection into the economy. There is at least one round of spending, hopefully more as the money switches from one consumer's hand to another. Tax cuts, however, could increase spending, but only if the people don't save their new money. If they start falling into recording equivalents, then they recognize that current tax cuts are going to have to be financed with future tax increases.